Welcome to the market update for the second quarter. It's amazing to think of how rapidly the world shut down and changed for the worse in February, March of 2020, and also amazing how rapidly we have recovered. Without dating myself, I'm old enough to live through a few pivotal events like 9/11 and the great financial crisis of 2008 and 2009. But I've never seen the speed and the change of mood from fear and pessimism, then switch back to extreme optimism in the last 12 to 15 months. Contrasting to the dystopia of March 2020 with the euphoria of July 2021. It's just amazing. And it's really the change over the last 6 months, which has much to do with fighting COVID and vaccines. Let's look at a few data points on COVID, which we believe is the main driver of optimism, the economic surge, and the subsequent rally in asset prices. Borrowing a chart from our friends at JP Morgan, looking at the chart on the left, the blue line represents the 7-day moving average of confirmed COVID cases. This peaked at 260,000 in January and has fallen to just 15,000 by the end of June. The black line represents deaths, which has fallen in a similar sharp manner. This is at least in part driven by vaccines, and at the end of Q1, 19% of the US was fully vaccinated, compared to 55% at the end of June, from 19 to 55% in just 3 months. Other countries are catching up quickly. Europe was lagging the US, but is catching up, with the European CDC reporting that those with one shot of vaccine in ages 18 or older, this has risen from 14% on April 5th to 62% as of June 27th. Canada was near 10% to start the quarter, and now has 68% of the country aged 12 and older with at least one shot. Again, this is a tremendous increase, which has driven the global economy, which Dave will touch on shortly. The increases in vaccines and decreases in COVID cases, combined with low rates and fiscal support, has been a very good backdrop for asset prices. Let's look at market returns for the quarter and for the year, where we see strong performance across the board. You're going to hear us talking about three themes: low rates, stimulus, and reopening as drivers for asset price movement. Looking at the top, the best performing index has been the Wilshire REIT Index, up 12.75% for Q2 and 22.7% for the year. The REIT sector benefits from all three themes just mentioned, and additionally benefits in a low yield environment when investors are looking for higher yield options. The Russell 2000, or small cap index, has also seen strong gains of 4.3% for the quarter and 17.5% for the year. Small cap stocks are historically pro-cyclical, benefiting from the reopening, given the higher percentage of names in financials and industrials, and less in technology. This is the 9th straight month of positive gains in small caps, the longest streak since December of 1986. The MSCI SMID Cap Index is just behind the Russell 2000, and the larger cap S&P 500 is trailing the small and the mid cap space by roughly 2% on the year, but has performed better in the month. Looking at international markets, the MSCI XUX index was up 5.6% on the quarter and 9.5% on the year. Strong numbers, but still lagging behind the US. The MSCI Emerging Markets Index is slightly lower at 5.7% and 8.8% on the quarter and the year. Why does the US continue to outperform international emerging market indexes? Let's go back to the three themes. First, rates. They may be lower in other parts of the G10, but they're low globally, so that's basically neutral. With stimulus, the US has been aggressive with fiscal stimulus as a percentage of GDP. And importantly, we must consider that to start the year, we expected a divided Congress. Once the Democrats swept the Georgia runoff, the expectation has been and remains for more stimulus. This supports US assets. Third, reopening. The US has led the world in vaccines and reopenings, with the exception of maybe Israel. But this helps explain the current outperformance year to date. As the rest of the world gets vaccinated and their economies return, we expect this advantage for the US will dissipate. Also, it remains to be seen in the US if we will keep fiscal spending at the rate we've seen over the past year. In other words, some of the drivers of US outperformance are expected to diminish in the second half of the year. I won't spend a lot of time here, but this is the Fed's balance sheet, and there are plenty of questions, including ours, on why the Fed continues to expand the balance sheet at such a pace when the economy is opening up and surging higher. We expect that the Fed will announce a tapering of the balance sheet as early as the Jackson Hole meeting in August. Looking at the U.S. yield curve, it helps explain fixed income performance for the quarter and the year. The bottom line is 1 year ago, at the end of June of 2020. The top line is the end of Q1 of 2021. So we saw a significant shift higher in the yield curve and a steepening. That's on the back of expectations for vaccines, higher growth, and higher inflation to start this year. In the second quarter, you can see that the curve has shifted lower and is slightly flattened. This is represented by the blue line. This reflects peak expectations of inflation near the end of March. It also reflects lowered expectations of stimulus, and also that the Fed has become slightly more hawkish, which would weigh on growth and inflation in the future. Switching gears to fixed income and commodities, remember a year ago when oil was $20 and gas was $2? Well, that's gone, as normalcy has returned and demand has returned with a vengeance. At the top is the Bloomberg Commodity Index. With the majority of the rally that we're seeing in energy prices, and this is something that we're all experiencing. Looking at fixed income, remember in the first quarter, we saw rates rise, which resulted in negative returns for most of the bond market except for high yield, which saw positive returns as spreads tightened. As I noted earlier when speaking about REITs, investors have been reaching for yield all year, which has resulted in spreads tightening across the board. Remember also that the 10-year yield peaked at 1.74% at the end of March. And as yields fell in Q2, the inverse relationship with bonds led to higher prices and stronger performance. The high yield index was up 2.7% for the quarter and is now positive by 3.6% on the year. The emerging markets index was up 3% on the quarter, which takes the year-to-date return to a slight negative of 59 basis points. Again, we saw in Q2 that the riskiest parts of the fixed income sector were the winners, and this is in high yield and emerging markets. This all lines up with what we noted earlier as the drivers: low rates, fiscal support, and the combination of lower COVID, vaccines, and economies restarting. This has driven investors to the riskier parts of the market. In the next segment, we will look at Wespath fund performance.